Hey there, everybody. Welcome out to night number 3 of your Advanced Options Workshop. I'm Scott Durfee. I want to be the first to welcome you out tonight. Listen, we've got a lot to cover and not a ton of time. It seems like we always run just a little bit tight. So I'm going to try and streamline tonight. A couple of things you do need to know. Number one is we will have a survey at the end of the event. We thank you for participating in the surveys that we have sent out so far and invite you to do that once again at the end of the event today. We'll be putting that link at the end of the event into the chat. Speaking of chats, there's 2 of us. There's hundreds of you. We probably won't have an opportunity to answer every question or attend to every comment that's put into the chat box tonight, but we will do our best to do so. Now, we do have a remedy for that. On Friday morning, 10:30 a.m. Eastern Time, we have a Q&A scheduled to talk about the topics from this Advanced Options Workshop. We encourage you to get into the event hub and submit your questions as we go. You can go back and do that as frequently as you'd like and submit the questions, as many questions even as you'd want to. Ben will be showing us how to do that this evening. And in fact, speaking of Ben, before I introduce him, ladies and gentlemen, everything that we're going to be doing here tonight will be for educational purposes only. We're not here to give advice in any way, just to provide education. We'll be talking about options tonight. Now, options contain a certain or a unique set of risks that are not suitable for all investors. You need to know that. You need to know that going on. And we will be talking about the risks, etc., around the various options that we talk about tonight. But again, remember that this is for educational purposes only. It's my pleasure to bring to you our featured presenter here tonight, Mr. Ben Watson. Ben, can I have your slide there, pal? Ben,
you got it. There it goes.
I'm a little faster than probably you were expecting, so I caught you maybe a little bit off guard there. But you can see that Ben's been an education coach here with us since 2005. He's the host of Your First Trade on the Schwab Network, separate but affiliated company. He specializes in teaching the Thinkorswim platform, technical analysis, stocks, option strategies. You think of it, he teaches it, at least as it is market related. Ladies and gentlemen, my good friend, Mr. Ben Watson.
Thank you, Scott, and welcome to all of you. Welcome to Ray Kimbrell, who's out there with Scott as well, helping out. And thanks to everybody who is watching this in the recorded version as well. We are glad to have you here with us. If you don't have the opportunity to join us live, you can participate in the conversation as well. Leave your comments in the comment section. But if you are here live, you've got the opportunity to ask those questions. And I know that you guys have been very active in asking those questions. Again, we may not get to all of them, but hopefully I'm going to keep an eye on them. I know that Ray and Scott are going to keep an eye on them as well. And we'll try to answer in general terms if we can. Probably won't get to each specific question, but let me just really quickly, as we get into this discussion, just refamiliarize you with my compatriots, I'm going to call them my posse, because there's no 2 guys that I would rather teach this workshop with than these guys right here. Scott Durfee has been doing this since 2006. Frequent contributor on my show on the Schwab Network, as well as on the network in general. You'll see him just about every single day on the network, and you'll see him up on stage when we teach this live. Ray Kimbrell, I tell you what, if you're in an alleyway and there's some bad dudes around, these 2 guys are the guys you want backing you up. Ray's been doing this since 2004. He is a Marine. He is a regular contributor on the Schwab Network, and he is very well suited to teaching this content as well. So I'm glad to have these guys with me here as well tonight. And tonight's discussion is going to be a little bit interesting because we now change things up. What we've been doing so far in this discussion is over the last 2 nights talking about splitting strike prices when we've been putting our spreads together for our advanced option strategies. Now we're going to keep the strike the same, but we're going to change or split up our expiration dates. And that's what's going to create a calendar spread, because we are taking two different points on the calendar and putting those together and building a spread trade with it. And we're going to look at why that is an important consideration and oftentimes an important strategy to have in your toolbox, depending on what the circumstances might be. Now, everything that we've talked about, right? All of these different strategies, long vertical spreads, iron condors, as a combination of short vertical spreads, calendar spreads, and ultimately tomorrow night when we get into diagonal spreads, are suitable for specific circumstances. And there is no imperative for you as a trader to have to treat every single one of these strategies as equal in your repertoire. You don't need to go out and trade every single one of these strategies. You may not particularly feel much affinity for iron condors or for calendar spreads or for long vertical spreads. If that's the case, don't trade them. Focus on what makes sense for you in your trading and your risk tolerance and your psychological tolerance as well, because some of these trades, like the iron condors, require some patience, like we talked a little bit about last night. And if you are not a patient person, sometimes that can be a little bit frustrating in terms of how you approach the trade. So let's jump into the whys of calendar spreads and talk a bit about how we might put this trade together. And I've got a number of examples that we might look at as we jump into this discussion. So our focus, again, we're going to be talking about the reasons why we would use this particular type of strategy. We're going to be talking about position size, entries, and exits, what might generate the circumstances to enter a particular trade, like a calendar spread. We're going to talk about the impacts of, as we always do, price, time, and volatility, those three major inputs into our option pricing. And we're going to see why that has a significant impact potentially on our calendar spreads. And then we're going to put together some illustrative examples along the way. So the objective of the calendar spread, to perhaps answer a little bit of that why question, because I know that some of you in the feedback survey, and by the way, I just wanted to say this, thank you to all of you. I'm grateful to you, as are Ray and Scott. We are grateful for you taking the time to fill out those feedback surveys and give us your information. Give us the feedback, not only numerically, but also verbally or verbatim in terms of what you enjoyed, what you didn't enjoy. That helps us to make these workshops better for you. So we appreciate that. But the objective here is to profit generally from a sideways trending underlying stock. Now, a calendar spread does not always have to be focused on a sideways trending stock. Just a stock that maybe is moving to a particular location that you feel it might end up at or near expiration. Does that sound familiar? Sounds a little bit like what we've been doing with long vertical spreads as well as iron condors. Now, ideally, a calendar spread gets to maximum theoretical gain when the price of the stock gets to a specific point. And that specific point isn't all the time, a function of the stock being sideways in its movement. So we're going to talk about that. So what we do to create this calendar spread is we buy an option and we sell an option with the same strike price on the same side. So if we buy a put, we're going to sell a put. If we buy a call, we're going to sell a call. And the way that we're going to construct these calendar spreads, although there are other ways to create calendar or calendar-like spreads, but generally the way that we are going to create these calendar spreads is these are going to be long calendar spreads, meaning we are going to buy the more expensive of the two options, and we are going to sell the less expensive of the two options. So it's going to end up being a net debit, or it's going to be a long calendar spread, meaning we're buying the calendar spread. Now, long in this particular case, and again, I'm just going to reiterate this because I know that this is the question that comes up oftentimes. Well, wait, because we're long doesn't that mean we're bullish? Or because it says long does that mean that this is a long-term trade? The answer to both of those is no. Long simply refers to the fact that we are buying the spread, meaning it is a debit spread, money out of pocket. So our goal is to buy it when it's cheap, sell it when it's expensive. So we want this calendar spread to get as expensive as possible, as quickly as possible, so that we can take advantage of that opportunity to buy low, sell high. Mary, yeah, it's a debit trade. We're buying this trade as a whole to begin with, selling it to close it. And you'll see how that looks here when we get into the construction of the trade. So here's what that risk profile is going to look like. Theoretically, we get to maximum gain right up there at that point, right? Kind of that little point at the top of that, sometimes referred to as a circus tent, sometimes referred to as a witch's hat, sometimes is referred to that. But this kind of peaked risk profile graph gives us that very discrete individual maximum gain point. And in order for that to happen, in order for us to get the theoretical maximum gain, the price of the stock has to, at expiration, end up at expiration right at that peak of our risk profile graph. Now, when that normally happens, it's a function of getting lucky, because that becomes a very low probability scenario to reach that maximum theoretical gain on the trade. So there are a couple of things offsetting that as we put this trade together. One, if we don't have a high probability of getting the maximum theoretical gain, then hopefully we've got a higher probability of getting to some gain on the trade. So we're going to look at taking the trade off when it has done most of the work or some of the work that it can do for us, meaning we're not going to take the trade off necessarily and not going to hope to try to take the trade off exactly at that maximum theoretical gain. We're going to try to take the trade off when it's done some percentage of that maximum theoretical gain. The other side, too, to think about is generally a calendar spread is going to be a relatively, and I say that cautiously, it is going to be a relatively inexpensive entry into the trade, meaning it's going to be a low capital requirement trade. Not always, and it depends on the price of the underlying stock, and it depends on the price of the options, and it depends on implied volatility and how much time is left to go until expiration. But generally, it's going to be a relatively inexpensive trade, and our maximum loss is going to be or maximum theoretical loss is going to be the total debit paid. Now, we're going to have some break-even points, but they can become a little bit difficult to challenge, to specifically pin down, simply because when we create the calendar spread, there is also that possibility of rolling the short leg, depending on how we construct the trade. So let's do this. Let's pop out to the Thinkorswim desktop software platform, specifically the paper money version of that. And I want to bring you into a particular stock right now. This is Amazon. Some of you are familiar with this particular stock. Some of you may have even been on their website today buying things. If you're my wife, you've been on it most of the day. But no, I'm just teasing. She's fine. But what I noticed about this particular stock is a couple of things. I noticed that I'm going to grab my magic marker here and we're going to line a couple of these out. One, the price of the stock has generally been moving higher. It's been running perhaps up into a little bit of a resistance level, right up here around this 229 or 230 level. But it's been primarily bullish. Two, there's an earnings announcement out over the horizon here, about a week or so, maybe a little bit less than a week or so for that earnings announcement. And what I also know about implied volatility is that the highest level of implied volatility has been up here. Generally, it stays kind of up in this range. It's a little bit lower than that, and it is starting to rise. So 1, 2, and 3 circumstances in this scenario are suggesting that, not a recommendation, but are suggesting that a calendar spread might be an opportunity for us to take advantage of this scenario. Now, one of the things we know, we talked a little bit about this on the first night that we were together. We know that when implied volatility is low, it tends to rise. And one of the drivers for implied volatility when it is low, for implied volatility to rise, is an earnings announcement over the horizon. That tends to drive implied volatility up because there's a growing expectation that the price of the stock might move. It either might move down against many of those long positions, or it might move up in favor of those that are perhaps speculating on that upward movement. Therefore, there's a lot of buying pressure that's taking place, and implied volatility typically tends to rise in that scenario. So hopefully that's what's going to happen. Ideally, that would be beneficial for our calendar spread. So I have an expectation here, and my expectation is that the price of this stock may continue to move a little bit higher, but not enormously higher in this particular case. In fact, I might be looking for the price of this stock to maybe move another 5 or 6 points to the upside, perhaps. And if I go back to previous earnings announcements and I look at where that previous earnings announcement is, a 10-point move on an earnings announcement is not outside the range of possibility in the near term for a stock like Amazon. Now, there's a timing issue here. We're kind of threading the needle a little bit with that earnings announcement because that earnings announcement can bring price movement, and it can bring big price movement or not. And that earnings announcement almost always creates, like it has here, if we look at this earnings back in the October timeframe, an IV crush or an implied volatility collapse after the earnings announcement, right? So here's how we're going to put this trade together. And I will show you what this trade looks like because I put this trade on earlier today so that I've got an example of this in my monitor tab. So let me close those annotations down, and we'll start to take a look at how we might build or put this trade together. If my expectation is still a little bit bullish, not hugely bullish, I'm not thinking the stock is going to continue to run beyond some of these levels of resistance, but implied volatility is still rising for a little bit, and that possibility of the price of the stock coming up into that 230, 235 range. So we're going to go over to the trade tab for Amazon, and I'm going to take a look over the horizon here. And I'm actually, in this particular case, I'm going to go out to the 15 August. So that's a little bit beyond where the earnings announcement is. Now, I could go shorter, but in order to create this trade initially, I wanted to show you the little bit longer time frame, the typical time frame, and then we'll talk about variations, right? So we'll establish the baseline, and then we will riff on that baseline. So the first side of this equation in building this calendar spread is determining where that calendar spread or where the price of the underlying stock is likely to go. So what I did first of all is I went over to the right-hand side and I said, look, the implied volatility for my selected expiration date, which is 23 days to go until expiration, is about 38%. And that would suggest through that proprietary calculation of expected move, about a 17-point move to the upside. So it's currently sitting at 228. And overall, if we were going to hold that all the way through till expiration, if we were to think about what that means, a 17-point move to the upside, so 228 plus 17 is 245. Now, I'm going to attenuate that a little bit. I'm going to come back down a little bit. Now, a couple of you are asking the question, well, wait a second. Open interest, do I care about it? Yeah, first of all, we want to pay attention to the liquidity of the underlying stock. And the liquidity of this particular underlying stock is pretty good. 27 million shares traded today, almost 28 million shares traded today. If we come back down and we look at our individual expiration dates and we were to change our layout to volume and open interest, I just want to kind of go through this again really quickly. So if I'm going to use, say, for instance, a call option here, I'm going to go out to the 235 strike. In this case, that's got 2,000 contracts traded today and 21,000 contracts in open interest. Very liquid. I've got a 10-cent wide bid ask, right, between the bid and the ask. And Bob says, hey, I'm assuming the move will be to the upside. Yes, in this case, I am expecting a move to the upside. I'm not necessarily, however, expecting a 17-point move to the upside. Because remember, Because remember, I said something on Monday. I said that expected move, this expected move right here, oftentimes overestimates how far the stock moves. The reality is oftentimes a little bit smaller. So the historical volatility and the realized move is oftentimes a little bit smaller, but this gives me a reasonable range. So I'm going to use that 235 mark, that 235 level. And I'm going to look at selling that 235. So I'm going to change back. Yes, Chris. I'm going to change back from volume and open interest. And we're going to go right back to delta, theta, and vega. Price, time, and volatility, right? Those are the three influences. Okay. So that 235 strike is delta sensitive, meaning it is directionally sensitive, right? It has a delta of 41 cents. So this option benefits if the price of the stock goes up. It doesn't benefit as much as the deep in the money option. But remember, we're selling this one. So that's kind of working against us. So I want a little bit lower delta here, so that's not working against us as much as if we were to, say, for instance, sell one that is a little deeper in the money. That's going to work against us if the price of the stock goes up. Now, this also has a theta component of about 18 cents per day, and it has a vega component or a volatility sensitivity of about 22 cents. So if implied volatility were to go up 1%, that is going to add about 22 cents. That rise in implied volatility is going to add about 22 cents to the extrinsic value of this option, which means that this is going to get about 22 cents per percent more expensive. Well, ultimately, I want this one to get cheaper. And that's what I want to have happen to my short leg. I want that one to get cheaper, and I want my long leg to get more expensive. So I've got a little bit of a conundrum at work here. So we're going to see how we might balance this out. So to build this trade, and I'll just show you, and we'll walk through this as we do this, I'm going to hold my control key down on my keyboard. And you can see that I'm doing that because those little numbers pop up here on the screen. You can see that. And if I left click on the bid price for that 235 strike, now I've created an order or a part of an order to sell the 235 call option. Now, I know a couple of you were asking the question, well, why don't we just sell a covered call against ownership of the stock? Well, that's fine if you own the stock. And selling a covered call, not a strategy that is outside the realm of possibility. It's a strategy that many, many traders employ. But if I didn't own the shares of the underlying stock, or I didn't want to invest the capital to buy the shares of the underlying stock, if I were to just stop right here and click on confirm and send, this is a trade that has infinite maximum loss, because the price of the stock could go up infinitely. Now, the probability of it going up to infinity between now and August 15th is pretty low, but it is not zero. So to think about this, if we were to just leave it right here, we have a naked short call. Well, I don't want to have a naked short call. I want to have some cover for this. Now, if we were to leave it there and we were to buy the stock, that would be a covered call. If we were to buy a long option at a different strike, that would be a diagonal spread, or it would be a vertical spread. But what we're going to do is, instead of splitting the strike prices, right, we're going to keep the strike price right here at the 235. I'm going to drop that back down. I'm going to close up this one that expires on the 15th of August, 23 days to go from now. And I'm going to come down here to the one that expires on the 19th of September, which is 58 days. Holy cow, only 58 days till the middle of September. That is crazy to me. So what I'm going to do is I'm going to open up this expiration, which is further out in time, and I'm going to come down to exactly the same strike price, the 235 strike. So notice something. This one, which is a little bit further out in time, has a 46 cent delta. You know what I'm going to do? I'm going to reduce the number of strikes. I had 100 strike prices in here because I was teaching my index options webcast this morning. And sometimes on those index where there are lots and lots and lots of granular strikes, you've got to open up the number of strikes significantly. In this case, I'm going to bring this back down. I'm going to say 10 strikes up and down. So we're going to go to both of these so that we can open up both of these at the same time. I think that sometimes can be helpful in seeing both of these. I want to keep this one right here. There it is, right there. There's our order to sell that one, and we'll just highlight it so that we can see it. Now I'm highlighting the 2 strikes that I am dealing with, right? Now, Robert asked the question, is there any reason that I picked 19 September as opposed to something else? Well, yeah, there is one particular reason, and that is liquidity. I'm looking for liquid options. So this 19 September, the only reason I chose that one over maybe the adjacent weekly expirations is the fact that that one's been listed for a little while, more so than this last weekly option, which expires on the 29th of August, which means there's likely more open interest and volume here at the 19 September expiration. That's what would be referred to as a normal or a monthly expiration. That's the 3rd Friday of the month, by the way. So what I'm doing is I'm selling the 235 in the August 15th expiration, and I am buying the 235 in the 19 September expiration. So Babu's Spoken has already kind of worked through some of these numbers here for me, but we can do that too. We can say, look, I am long 46 deltas. So if I take 0.46 and I subtract from that 0.41, that means I'm left with 5 deltas. This is not necessarily a directionally sensitive trade. This is not a directionally sensitive trade. Remember, I'm expecting movement to a particular location, but not a huge movement. I don't need big directional movement. I just need a move from where it is now at 228 to 235. To get to close to maximum theoretical gain. So I really don't need big deltas here in this particular case. So the next thing I want to look at is that influence of time decay. Now, somebody asked the question, why not go further out in time, right? Why not go out to the October or the November? And you certainly could. But the October and November are going to be more expensive. Now, they are going to have a correspondingly slower rate of time decay. That might be beneficial, but they're going to be more expensive, so it's going to be a higher cost to enter the trade. And we'll see that here, and I'll look at this as an example in just a second. So as we put this together real quick, right? And you're right, you do get a little bit more advantage of that theta, but it's always a trade-off, right? Better theta sensitivity and more money. That's always going to be the trade-off. But here's what we've got. Now, if I look at my net theta, I've got 0.18, and I subtract from that 0.10, I've got 8 cents of positive theta in this particular case. I'm left with 8 cents of positive theta. So every day that passes, that short leg is going to decay away by 8 cents faster than the long leg. And that's exactly what I want to have happen here. That's, again, one of the reasons for splitting the expiration dates. So I've got a theta disparity in this particular case. All right. So now the next thing we're going to look at is volatility sensitivity. So I've got 22 cents of volatility sensitivity in the closer dated expiration. I've got 36 cents of volatility sensitivity in the longer dated expiration. So that means I'm left with 36.36 minus 0.22. I'm left with positive 14 cents of Vega sensitivity. So if implied volatility goes up, that's going to benefit my long leg, and it's going to benefit my long leg more than it's going to hurt my short leg. So this becomes a volatility or an IV sensitive trade, even more so than directional, even more so than the passage of time. That's the reason for looking at low and rising implied volatility. So let's just kind of quickly review our sensitivities here. This is a directionally neutral trade. We're left with about 5 deltas. It is a theta positive trade to the tune of about 8 cents, and it is vega positive to the tune of about 14 cents. So of those three influences, price, time, and volatility, the greatest influence of those three, if we look at what those numbers mean, the greatest sensitivity, the greatest influence is a rising implied volatility. Cool. I like that. Because that means if implied volatility what implied volatility does, which is when it's low, it rises. Going into that earnings announcement, if implied volatility rises into the earnings announcement, that's going to benefit us in creating this trade. So we've put this trade together. Let me close my left-hand side here. There's the first leg of our trade. Here's the second leg of our trade, and I'm just going to hold my control key down, and I'm going to left-click on the ask price of my longer-dated option. And you notice now what this does. This now creates a long calendar spread. It is a net debit trade. Cool. And it's going to cost us $2.75 per share times 100 shares. So if we go to our confirm and send, here's the thing. The maximum theoretical loss on this trade is what we're paying for it. Maximum theoretical loss on this trade is what we are paying for it, right? So it becomes a trade that benefits from rising implied volatility, gentle stock price movement, and gently drifting off into the passage of time. So let's do this. I'm going to take this and we're going to go to the Analyze tab. And I've already put this trade on. I'm going to look at the Analyze tab here. Here's our trade. $2.85 net debit, $285 max theoretical loss. Where does the price of the stock have to be in order for us to realize maximum theoretical gain? It has to be at expiration right here at that target. It's got to hit that very small target, So, like I said, remember, we're threading the needle here in terms of when we're going to manage this trade, right? But that means we're going to look at taking this trade off when it has done what it can do for us. We're not necessarily going to hold this trade through the earnings announcement, beyond the earnings announcement, to expiration. We're constructing this trade so that we can benefit from, because remember, the passage of time isn't really helping us all that much, maybe 8 cents a day, but that rising implied volatility is helping us. Directional price movement, not so much. So here's the way that we're going to put this particular trade together. Is we're going to sell the 235 in the August expiration. We're going to buy the 235 in the September expiration. Now, what I'm looking for in this particular trade is maybe 25% to 50% of what we might theoretically get as our maximum theoretical gain. Now, the problem with calculating maximum theoretical gain on a calendar spread is if we were to just calculate maximum theoretical gain for one iteration of the trade, that's fine. But there is the possibility of rolling this spread. So look, one way we can calculate this, and this is where the Analyze tab can be very helpful, is I can put my cursor right here at that 235 level, and I can come over to the left-hand side, and I can say, hey, this spread that I paid $2.85 for, maximum theoretical gain at that expiration might be somewhere around $5.63 times 100 shares, so 563. So if that's my maximum theoretical gain, and I don't expect to get that maximum theoretical gain, how much theoretically could I get? Now, this becomes a little bit difficult to calculate because we're really just kind of discretionarily putting our line on that point on the risk profile graph, and from there calculating. So there's another way that I oftentimes will use to calculate the potential gain of a calendar spread. Notice that the amount that we're paying here is $2.85. I'm going to open up my calendar or my calculator over here on the left-hand side once again. So $2.85 times 2 would be just about $5.70. That's just about where we were looking at in terms of getting to that maximum theoretical gain. So this is a good kind of rule of kind of shorthand, kind of a heuristic that helps us to specify how much we might see as that maximum theoretical gain. So I might say, look, doubling the amount that we paid for it would be a really great gain, 100% gain on the trade. But if I know that I'm not likely to get that 100% gain on the trade, how much could I make? So what if I were to say, all right, I know that if I'm going to make $2.85 as 100%, right? 185, or excuse me, that's 100% gain. What if I were to divide that by 4, or in other words, times it by 0.25, and get 25% of that maximum theoretical gain? That would be 71 cents of gain in this trade. So if we did this, if I went from 25, maybe even 50%, I'm going to go to 25. I'm going to be a little more conservative here in this particular case. So I'm going to say, look, I traded this, I paid for it $2.85. And if I add to that plus 0.71 cents, 71 cents, which is 25% of what we might get in doubling that price. Now, if I could take this trade off for $3.56, if I could sell this for $3.56, I'm realizing about 25% of my maximum theoretical gain. But I'll tell you what we've done. We've now increased the probability of success in this trade. So watch what we're going to do now. So I'm going to come up and I'm going to put my cursor on this trade. I'm going to put it on this line and I'm going to say, where am I going to see roughly $3.56? So $3.56 is going to be somewhere right about here. $3.56. We'll just call it right there. And I'm going to put a line right there. And then I'm going to come over here at $3.56. And I'm going to say, all right, let's add a slice right there too, right? So I've got a slice right there and I've got a slice right here. So what that tells me is the range at which I might see that gain that I'm looking for is now not this wide. It is now this wide. Does that make sense? I've increased the probability of success in this particular trade. Increase the probability of success in this trade because I've widened out the range in which the price of the stock can be in order for me to get to that gain. So from 240 on one hand on the upside to on the other side about 230. So here's what the stock has to do. The stock's got to go maybe to 230, maybe all the way as high as 240. If it goes up beyond 240, now I'm starting to lose. If it doesn't go up to 230, I'm not making as much, right? So I'm trying to take the trade-off in that kind of fat middle section of this range. I'll show you how we're going to do that. So we're going to take the trade-off if it trades at $3.56. So let's come back down here to our order. And somebody asked me this question last night. How do we make this a closing order while we're still putting this together? You see right now where it says advanced order in the lower left-hand corner? We're going to change that from single order because otherwise we're just sending off this single calendar spread. We're going to change that from single order, and I'm going to make it first trigger sequential. So I got a little drop-down box. I changed it to first trigger sequential. And then I'm going to right-click on that order that I have right now, and I'm going to select create opposite order. Because if we bought the calendar spread to get into it, we got to sell the calendar spread to get out of it. And I'm going to say, look, I know that I want to get out of this calendar spread if it trades for $3.56 or more. So or more when we're selling something tells us that this is going to be a limit order. So we're going to say, fine, Let's get out of this trade. If it trades at $3.56 or more, we're going to make that good till canceled. And the way that we've set this calendar spread up is if the price of the stock moves, if implied volatility rises, if time decay works as time decay does, which is only in one direction, and it's only working in our favor in this particular case, then as long as the value of this calendar spread gets to $3.56, take that trade off, and we've now made 25% of our maximum theoretical gain. Here's the other side of the coin. What's the potential loss in this trade? The potential loss in this trade is $2.75. Remember, this is a low probability trade. So when we have a low probability trade, what are we going to have? High gains or low gains? Low probability trade potentially has the possibility of getting to that maximum theoretical gain. But what we've done is we've changed the probabilities. We've changed this from a low probability trade to kind of a middle or even a slightly high probability trade as we put it together. So I'm okay taking a possible maximum gain in this trade, or a potential gain of about 71 cents, or in other words, about 25% of the maximum gain, for the sake of risking 275, because I know that that's a higher probability scenario. So we're going to put this trade on that way and actually click on confirm and send, make sure that we're aware of the transaction costs and make sure that all of the circumstances are what we want them to be. One is to open, one is to close. And I already put this trade on. I put this trade on earlier today. I'm going to go to my monitor tab and we'll take a look at this trade and we'll see what it has done over the course of the day. So I'm going to open up my group here, which is our Advanced Options Virtual Workshop. There's our Amazon trade. I bought this calendar spread earlier today for $2.85. It has now gone down to $2.75. So it's lost a little bit. And one of the reasons for that is implied volatility kind of went down a little bit today. So you can see the importance of low and rising implied volatility on this type of trade. Right? So this is a long call calendar spread. And if we go back to the chart, we kind of assume this was looking for that bullish to neutral movement with the expectation that implied volatility was going to rise. But there's a conundrum here. We know that when call options get more expensive, when the price of the stock goes up, oftentimes call options go, or implied volatility does what? Goes down. So that was kind of working against me a little bit here. Yeah, Jordan, this is very much a volatility play. So I put together a couple of other examples here. Before I do that, what I want to do really quick is I want to pop back over here to the slide deck, because I know we've been getting a little bit deeper into the platform here. I wanted to just quickly remind you, this is where you can go to learn more about the platform. You can click on that QR code, or you can type in the link down at the bottom and you can join and sign up for, schedule 45-minute walkthrough. You can do this once every 6 months. Great opportunity for you to learn more about the platform. Plus, if you pop over here to the Trader Talks webcast page and you type in, let's type into our search box, Thinkorswim. You type that into the search box. Here's Getting Started with Thinkorswim. That's one of 8 lessons. Getting Started with Thinkorswim. There's the whole playlist. Thinkorswim desktop chart setup. How do you download it? How do you use the Thinkorswim platform for the first time? What's new in the Thinkorswim platform? Using things like ThinkScript studies. A lot of great resources to be able to help you use that platform to the best of your ability. So I'm going to pop back to that QR code for just a second, and you can jump in there. Now, when you go to that Trader Talks webcast page, or you're seeing it on the screen right now here in YouTube, go ahead and click on that subscribe button. That's going to help you to stay connected to the Trader Talks webcast channel. It helps you to set alerts. It brings it to the top of your search list. It also helps pop this content up to the top of the list for other viewers as well. And we appreciate you doing that, right? So that's where we are at this point. Now let's pop back into our Thinkorswim desktop software platform. And let's take a look at an example, perhaps that is not quite so bullish, that is maybe a little bit more bearish to neutral. So I'm going to go back over here to our monitor tab. And I've got a couple of those in here. In fact, there's our iron condor from last night. This is one that I had looked at earlier today, and in fact put this trade on earlier today. This is ExxonMobil. And similar type of scenario, but let's look at the chart for ExxonMobil. So I'm just going to come over here to my chart grid. XOM. Whoops. XOM. There we go. There's ExxonMobil. And this is maybe a little bit more bearish to neutral. A little bit more bearish to neutral. The reason I'm saying bearish is because generally there's kind of been this downward trend. We've got a little bit of a descending triangle happening here. We've got implied volatility that is low and rising into the earnings announcement. But overall, this is a stock that has been kind of trending sideways. And if you've been watching crude oil prices, you've been seeing crude oil prices pushing a little bit to the downside. That's going to be weighing on ExxonMobil. So there are a couple of other forces at work here. So if we start to look at this, now we're looking for that downside movement. This is potentially bearish to neutral. So where might this move to? Well, I've got a support level down here to about 107. If this were to come back down and go towards that support level around that 107 mark. But let's go to the trade tab. And let's see how we might construct this trade. And I, in fact, did this trade a little bit closer to the time frame. So I'm going to go to my short-term time frame here. I'm going to go to the 8th of August. Now, I know that over the horizon, I've got an earnings announcement. And that earnings announcement in this particular case is on the 1st of August. So that's next week. That's next Friday. So this is going to be a relatively short duration trade. I want implied volatility to rise into that because I want to be able to take this trade off prior to, generally, that earnings announcement. So I'm going to go back to my trade tab and I'm going to say, fine, let's look out over the horizon a little bit. Here, I could go to the 2 days to go until expiration. I could go to the 1 AUG expiration. That already has a little bit elevated implied volatility. So does this one, 8 AUG expiration. And I'm going to open that one up. And I'm going to look at that implied move number, that implied volatility and the expected move. And it's about 5 points. So if we're looking at this objectively, up or down, that means that the price of the stock, let's kind of go through our calculator here, currently sitting at 109, we'll call it 110, could go up or down about 5 points. So that's up to 115 or down to 105. So I'm going to kind of go within that particular range. And that's where I came across this strike price right here, the 106 strike. And that's the one I'm selling in this particular case. So I could sell the 107. I could sell the 105. I'm selling the 106. I'm kind of striking a balance there in between the expected move and where that level of support is. I know that that support is at 107. This is a little bit below that level of support, but I know that my expected move puts it down to 105, which is a little bit beyond where that support level is. So I split the difference and I went to the 106 strike. Okay, I went to the 106 strike. And we'll just do the same thing. I'm going to go to the 106 strike and I'm going to click on the control key and I'm going to left click on the bid price to create this trade. There's my 106 strike. And if I were to leave it right here, this is a short put. Now, if you have cash in your account and you would leave this right here, that would be a cash secured short put, which has a bullish bias, right? But it requires me to hold a fair amount of cash. No, it's not infinite maximum loss like our naked call was, but that loss potentially is defined, but the price of the stock has to go all the way to zero. So here's what we're going to do. In conjunction with that, I'm going to open up this expiration, which is the 22nd of August, 30 days to go until expiration, kind of still right back at that back edge of where that time decay starts to roll off the side of the cliff. Because I still want this to be time decay sensitive or theta sensitive. So I'm going to go to the 22 August expiration, 30 days to go until expiration, and that's the one that we're going to buy at the 106 strike. So I'm going to complete the creation of this trade. Remember, I created the order to sell the 106 put. Now I'm going to create the order to buy the 106 put a little bit further out in time. That creates a 63-cent debit. I have a slightly bearish expectation. I expect that the price of the stock is going to go from where it is right now, 109 to 106. Now, a number of different ways that I could choose to trade a bearish expectation on the price of the stock. I could go long a put, but that's going to be expensive. And it's going to suffer from time decay. And if implied volatility goes up, that helps, but it's going to suffer from time decay. And it's got to move quickly, and it's got to move to a greater degree. So putting this trade together, this calendar spread together, I'm kind of balancing the forces a little bit. I'm balancing the forces of direction, time, and volatility. And that's kind of what the calendar spread is designed to do in terms of your strategy repertoire, is give you the ability to trade volatility increases and keep everything else in balance, because it's a little bit like spinning a plate or splitting multiple plates, because if one plate moves or starts to get wobbly, some of those other plates are going to get wobbly. So that being said, we put this trade together. Let's take a look at the net Greeks on this trade. So we've got, I'm just going to bring my calculator open here. We've got a net delta of 0.29, and we subtract from that 0.23. So we are 6 deltas sensitive to direction. A little bit more than our Amazon trade. Expect a little bit more movement or a little bit more sensitivity to that directional movement. That's fine. That's about where we're going to find with a calendar spread, is somewhere in that 5 to 10 delta range in terms of its directional sensitivity, depending on how you construct the spread. Now, if we look at our theta sensitivity, we've got 4 cents of theta sensitivity in the long leg and 6 cents of theta sensitivity in the short leg. That means that we are positive theta by 2 cents. Positive theta by 2 cents. Cool. Every day that passes, 2 cents is going to eat away from is going to help my premium, right? Now let's look at Vega sensitivity. So my long leg is positive 11 cents Vega. My short leg is positive 7 cents of theta sensitivity. So 11 cents minus 0.07, 4 cents of Vega sensitivity. Now, John asks a great question, and I'm glad that John asked that. And the question is, do we need to worry about assignment? Well, yeah, because we're short an option. So that's always a concern. But in terms of worry, because as opposed to, say, for instance, the vertical spread, either the short vertical spread or even the long vertical spread, we have a long leg that is longer dated to choose and to use as cover if, in fact, we are assigned the obligation on our short leg. So if we were to be assigned early on this short 106 put, meaning we've got to buy the stock at 106, okay. If we're put the stock, guess what? I have a longer dated, 30 days to go until expiration, 106 put that I am long, which gives me the right to sell the stock at 106. So it mitigates somewhat that early assignment potential nervousness, fear possibility, because of the splitting of the expiration dates. That gives us a little bit of latitude in terms of using the long leg as satisfaction for that obligation. One of the reasons why calendar spreads are sometimes used ahead of an earnings announcement, where there is the possibility of an early assignment, or ahead of, say, for instance, a dividend payout, where the price of the stock might go down a little bit because of the dividend, but there's the possibility that you could be assigned early because Someone wants to take possession of the stock, so they exercise their right to buy the stock from you. You get assigned, you have to deliver the shares of the stock, but you've got a long leg to be able to buy them at the same price. So it gives you that opportunity to mitigate some of that risk or some of the concern. The risk is still there. I mean, the risk of it happening is still there. But some of the concern about what the circumstance might be, because you've got an expiration split in between your long leg and your short leg. So you've got more time. It mitigates some of that time imperative sense in this particular case. So when we create this trade, let's take a look at what this trade would look like on our Analyze tab. So I'm going to go over here to our Analyze tab, and here's what this trade looks like on the Analyze tab. Let me drop this back down. So here's the trade that we created, 71-cent net debit. Maximum theoretical gain, let me kind of squish this back over here so you can see it. Maximum theoretical gain occurs if the price of the stock at expiration is at 106, in which case that would be that in order to realize that maximum theoretical gain, you'd be put the stock at 106 and then sell the stock at 106, and there would be no more extrinsic value left. It would be all intrinsic value, and you realize the difference in terms of that intrinsic value, which would be the difference between where the price of the stock is now and where that 106 strike is. So that's where we kind of get to that. So our max theoretical gain in this trade is about 120. So if we were to take this and double it, again, kind of getting to that rough idea, 0.71 times 2 is, 71 cents. 71 cents times 2 is about $1.42. So that's pretty close to where, if we were to hover that over there, the expiration leg is telling us, right? So let's take that 1.42, and in this one, let's shoot for 50% of our maximum theoretical gain in this particular case. So we're going to take 142 and we're going to divide it by half. That gives us 71 cents. All right, I get that. So if we could see this double, right? Did I do that correct? 0.71 times 2, $1.42, divided by 2 is 71. Yeah, okay. So that's 100%. All right. So I'm okay. If I can get out of this, well, that's going to give me, let's take 71 cents. That's our gain in the trade. And let's divide that by 2. That gives us 35 cents. So 0.71 plus 0.35 is $1.06. So if we can get out of this trade for $1.06, then I'm happy with that potential gain in the trade. So I get this going in our favor. I get the idea of taking the trade off, and if we come back up and we pop this one open and we say, fine, I'm going to take this trade off if it gets to $1.06. So we're going to trade this, change this to first trigger sequential. That's what we've got right here. Right click, create opposite order. We're going to put in a limit order at $1.06, 1.06, and we're going to make that good till canceled. Now, when we leave this as a limit order, when we're selling, a limit order says or better. And when you're selling, or better is selling it for more. So I can sell for $1.06 or more. Great. And close the trade down and walk away. Now, what happens, however, if implied volatility were to fall? Because remember, that's the biggest sensitivity of this trade. If the price of the stock were to go up a lot or down a lot, right? And we get into that maximum loss scenario here. Well, are we okay taking a maximum loss of 71 cents? $71 in this particular trade for the opportunity to make $35? Yeah, I think so, because what we've done is we've changed the dynamics of the probabilities in this particular trade. This is not, like I said, not a high probability trade, but it is a trade that can be beneficial in terms of the scenario of taking advantage of the forces at work. Now, doing is king. One of the questions that people ask is, where do we see the probability of the trade being profitable? Well, we might think about this in the context of, where do we see the probability of the trade getting the maximum theoretical gain? Because the reality of the situation is, I don't know exactly where this is going to end up hitting that potential exit. Because remember, our trade is this. Our exit order is $1.06. Because there are a number of things that can happen in order for me to get to that $1.06. And that is, the price of the stock could move, implied volatility could rise, or time decay could just kind of eat away at that front month a little bit more. So if that's the case, a number of circumstances could occur. Primarily in this particular case, though, that implied volatility rise is going to benefit this trade, passage of time is going to benefit this trade, and the price of the stock moving a little bit, not huge to one side, not huge to the other side, but a little bit, puts us in that scenario of potentially taking maximum theoretical gain, or where we've specified our gain. Hi, guys. Yeah,
hey,
Ray.
Ben, got an idea for you. I know you kind of do this every once in a while, and maybe this will help the folks looking at the chats and the questions and trying to understand the Analyze tab. And you've done this before, and it works really well. If you could show them how you can simulate that rise in implied volatility and how that increases the peak of the hat or the tent or whatever you want to call it, that might bring it home to a lot of folks on the chats where they're asking the question.
Absolutely. So let's do that. While we're here in the Analyze tab, let's kind of look at this again from that scenario. So I'm going to put my price slice right here at that 106 strike, right? We know that that is going to be our theoretical maximum gain in the trade. So we're left in this trade with a little bit of delta sensitivity and positive theta, positive vega. That's what this is telling us in this particular case. So it's not huge delta. You could use that as a proxy for probability, but if we were to change this, so here's what we're going to do. You notice this second line where it says positions and simulated trades. And if I come over here to the right-hand side where it says interest rate, that's going to assume the current risk-free interest rate. It's got date of the trade, that's today. And if we open up this little gear icon right here, we now open up another couple of scenarios here. We open up a volatility adjust and a stock price adjust. Now, this is assuming that the price of the stock is where it is right now, 109. That's what's giving us this purple line on the Analyze tab. This purple line on the Analyze tab. But if we were to change this, so let's just play the what if game for just a second. And I want you to keep an eye on this delta, theta, vega component. And I want you to keep an eye on the P&L of this trade. So if the price of the stock were to drop, we got to simulate the passage of time. So let's say the passage of time happens, because we know that that's inevitable. Let's say we're here at next Friday, which is the 25th. No, I'm sorry. That's not next Friday. That's this Friday. So we're going to push this out. Let's go out to the 31st. Let's go to next Thursday. So I've adjusted my date, and you can see what's happened to that purple line. That purple line has risen. That purple line has gone up simply because of theta, and our theta component has increased a little bit. Our profit and loss has gone up a little bit because theta has done what theta does, and it's worked in our favor in this case. Now, let's simulate in our next step of our what if. Let's simulate the price of the stock making that move in that next week down to, or very close to, our expected price, which was 106. Now you see what's happened. It's kind of shifted a little bit here now that that purple curve has gone up even a little bit more. And if we were to open up our slice, you can see what's gone on here. Well, because it's done that without a corresponding rise in implied volatility, we've lost a little bit in the trade. Because now time has passed, but the price of the stock has moved, but implied volatility hasn't really moved. So what if implied volatility in this particular case goes up, let's say 5%? Whoops, Let's come back and let's take that to our 5% level. Oh, now you can see what's going on here. That peak is rising. We can model that rise in implied volatility. We can model the move in this simulation, and we can see what that trade may end up looking like. You can see that that purple curve moves. And the closer we get to expiration, right, because we know that we are still further away from expiration here. This expires over that horizon just a little bit on the 8th of August. Now we're getting very much closer to that range here. So, oh, I bumped my slice. That's what happened. Let me put my slice right back here on that 106. So you know what's going on now? We're at 106. The price of the stock is close to 106. We're close to expiration. Implied volatility has gone up. Now let me show you what might happen if implied volatility, if we were to carry this through. Thank you, Arturo. You saw that. I didn't catch it. Thank you for catching that. If implied volatility were to crush after the earnings announcement, because now this date, 8/7, is a couple of days after the earnings announcement. What if implied volatility were to crush? What if implied volatility were to go down 5% instead of up? Oh, that wipes out about $60 of potential gain in the trade simply because of that Vegas sensitivity. Simply because of that Vegas sensitivity. So, yeah, some people use calendar spreads as a pre-earnings play, and then others use it post-earnings to play that volatility crush. So there are a number of different ways. I like Roger's question, which is, what are the criteria for closing the trade? 25 to 50% of the maximum gain, 21 DTE. Sure, you can use either one of those. You can use either one of these. Now, I put on trade like this earlier today, and I wanted to talk about one other scenario here, or another scenario that we could look at as well. And that is, what if we choose to roll the short leg of the trade to another expiration? And I'm going to show you how we might do that. If you were with me in my index options webcast earlier today, and I teach that every Wednesday morning, we put on a calendar spread on an index option with a bearish expectation, and the short leg had 2 days to go until expiration. Well, now we're at 1 day to go till expiration. So I'm going to see if maybe we can make this a little bit more beneficial by rolling that short leg. So I'm going to go over here to my monitor tab, and I'm going to go to my index options group, and we put that trade on the NDX. Now, I'm just going to say this. This is an index. This is a cash-settled index because there is no underlying stock here to buy when you trade options on the index. But at 11 a.m. Eastern time every Wednesday, I teach a trading index options webcast. We happen to use this particular example. So I'm just going to say this. Trading index options, the mechanics of the index options from the way that they function Greek-wise and relating to strike price and intrinsic and extrinsic value and all of those things, there's no difference than with an equity option. There are two primary differences between these options and an option on an individual stock. One, this is cash settled. So when this trade settles, it settles to cash, and it's either going to be a debit or a credit. And two, these are European style options, which means that they cannot be exercised prior to expiration, which means that you don't have early assignment risk. So we put on this trade earlier today, and it is 2 days till expiration, 6 days till expiration, index option calendar spread on the NDX. So let's go to the chart. And let's put in NDX, and I want you to see this. So my expectation was that implied volatility was going to rise and that the price of the index was going to go down. It did neither of those things. In fact, it started to go against me. So we might adjust this trade. We might roll it to see if we can pick up a little bit additional credit. I'm going to go to the trade tab, and I'm going to show you what we've got at this point. So right now, my short leg expires in 2 days. 1 day now because we're now past today's trading. And my long leg expires in 5 days. I have one opportunity to roll this. One opportunity. I don't have multiple opportunities because I don't have multiple expirations in between those two. So the first thing I've got to do, I've got in order to take this trade off. If I go back to my monitor tab and I go up here to working orders and I look down here at my NDX trade, I've got in order to take this off if it goes up to about 50% of the maximum theoretical gain. So before I do this roll, I'm going to cancel that order. And that's a good habit to get in making sure that you don't leave an inadvertent stop order out there. Okay, you don't leave an inadvertent stop order out there. So I canceled that order to take that trade off so that I don't have an inadvertent fill in that order. Now I'm going to go back to my monitor tab and I'm going to say, look, I want to roll this short leg out date-wise one more expiration. So what I'm going to do is I'm going to right-click and I'm going to create a rolling order. And if I'm buying it back and selling another one, I'm going to create a credit transaction. So I'm going to be looking to roll the July 25 or the July 28 put, the July 25 put into the July 28 put. That's going to be the roll that I'm looking for in this particular case. If I were to select this one, that would be rolling my long leg. I don't want to roll my long leg. I want to roll the short leg. I could roll the long leg, but I don't want to in this particular case because I want to keep that where it is. So I'm going to roll the short leg, and I'm going to select this spread. So it ultimately ends up becoming a calendar spread anyway. So now what I'm doing is I'm bringing in $11.40 credit by rolling from one expiration to the next. So bringing in that additional credit, guess what I've done? Because look, I paid, if I go back to my monitor tab, I paid for this spread to begin with $34.90. If I accomplish that roll and I bring in another $11 of credit and I extend the duration by 2 or 3 days, that short leg, I've now bought down the total cost of this spread by another $11. That's more than I ended up losing, or just about what I ended up losing in the trade today. So I'm not fixing it. I'm just simply using what I can do with the flexibility of calendar spreads and the flexibility of rolling to help to maybe bring this back to where it has a fighting chance. So I'm going to accomplish that roll that I put together. And with that roll trade looks like this. Buy back the one that I'm short, the 25 July 22,900 put, and sell the 28 July 22,900 put. Now, what do I know about those two strike prices? I know that the 25 July is going to be less expensive than the 28 July, which is why I'm getting a net credit. So this is one of those scenarios where you are rolling this trade for a credit. And I've got a little saying that I use to remind myself what I want to do. Roll it for a credit or just forget it. If I didn't have the opportunity to roll this for a credit, then I'm not going to bother rolling the spread because it doesn't benefit me in that particular case to roll the spread. I would simply look at taking the trade off potentially. So roll it for a credit or just forget it. Roll it for a credit or just forget it. That's kind of the thought process here. So I know a number of questions have just started to come through. Keep in mind, a roll is not a magic wand, simply a convenience factor, and it depends on the liquidity in the target expiration and strike. Same strike here in this case, just different expiration. We rolled it a little bit closer. Now, if I wanted to take this trade off completely and I said, look, I don't want to take that loss of $11. I want to just take this trade off. I could right click, create a closing order, and I could sell this calendar spread off for what it's currently trading at, $22.20 right now. And I wouldn't realize theoretical maximum loss on the trade if that's what I want to accomplish doing. So you can always take the trade off. Again, like we've talked about with long vertical spreads, with iron condors, oftentimes we don't put a stop order in a trade like this, and I'll show you why. Oftentimes we don't put a stop order in a trade like this because we adjust our money management to match our risk in the trade. So if my risk in the trade is $3,400 and that meets my portfolio risk or my trade risk, that's the number of spreads that I can do. If that's too much, I'm going to change the spread or look for a different symbol. I'm not going to try to stop that trade out for less than its maximum theoretical loss. I'm simply going to go to that maximum theoretical loss to let it kind of work in my favor, because I know that I could be stopped out on a volatility change, and then the price of the trade goes to where I wanted it to go to begin with. Now, I happen to notice a couple of things. One, there's a feedback survey in the chat. Thank you very much, guys, for posting that up at the top of the chat. Thank you for filling that out. Okay. Now, I want to do one more thing here, and I want to talk a little bit about selection, because many of you had asked the question, what kind of stocks would we use to select to trade or calendar spreads? So here are some of the considerations in putting together a calendar spread. The underlying stock, we generally want a stock, as we always do when we're trading options, that has high daily trading volume for the stock and high trading volume generally for the option itself. Consider securities that aren't necessarily just sitting neutral, but are trending towards a price target. And here's one thing to think about. If it's moving in a bullish direction, use calls for your calendar spread. If it's moving in a bearish direction, or that's your expectation, use puts. If it's bullish, use calls. If it's bearish, use puts. Now, this says consider securities in the lower range of their 52-week implied volatility range. Low and rising implied volatility benefits these trades, and consider options that have high trading volumes, narrow, tight, small, whatever you want to describe them as, narrow bid-ask spreads, so that you minimize the amount of slippage. A couple of considerations in terms of exiting. If the short option is deep in the money, if the price of the stock has gone quickly and far in one direction, consider closing the spread. If it's slightly in the money and you have some opportunity to roll, consider rolling it, but roll it for a credit or just forget it. And if it's about to expire out of the money, consider rolling it and extending the duration and bringing in a little bit more credit, or letting it expire or closing it down positively prior to expiration. Now, remember, rolling doesn't remove transaction costs. You got to keep that in mind. And there's some pitfalls, considerations. Remember that this trade is a lower probability trade than other types of spreads. A short vertical spread, long vertical spread, even depending on how you construct it, both of those types of spreads have a higher probability of success. But they're also going to be generally more expensive if you lose, more expensive to enter the trade. It's difficult, if not ultimately getting really lucky, to get to that maximum theoretical gain, because in order to get to that maximum theoretical gain, the price of the stock has to be exactly at the strike price at expiration. That's hitting a really small target. Now, one other pitfall is not considering closing or rolling the trade if it moves, or if it's, if end up being assigned those shares. And the final one here to think about is failing to keep in mind falling implied volatility. If for some reason implied volatility goes down, and this is why oftentimes, and I'm just going to say this in general, it's not always the case, but in general terms, many traders will use put options primarily for calendar spreads, simply because if the price of the stock goes down, typically implied volatility goes up. So if it's moving directionally the way that you expect it to go, they're going to use a put option, because that has kind of that extra kicker of that implied volatility. So if you have an upward trending stock and you're trading the calendar spread out of the money a little bit and the price of the stock goes up, oftentimes that can result in a decrease in implied volatility. So be aware of that if implied volatility continues to go down, or if you happen to hold on to the trade through the volatility crush beyond an earnings announcement, then you could see that volatility crush and take away some of that value of your long leg, which is really the driver of the trade, is that long leg, as it was in the long vertical spread, and here in the calendar spread as well, because this is a debit trade. Now, I know a number of you asked the question here in terms of, wait a second, you mean there are additional resources that I can draw upon? And a number of you said, I didn't know that there were any of these weekly webcasts, and that's great. I am so glad that some of you are here and you are brand new. I'm glad that all of you are here. That didn't sound right. I'm glad that all of you are here. I'm glad especially that some of you who have never been here before are here as well, because that gives me an opportunity to share with you some of the additional resources that you have at your disposal. First of all is this page right here, schwab.com/coaching. schwab.com/coaching. And Ray's put the link here in the chat a couple of times, I've noticed. This is a great place to start. If you go to this calendar right here, live webcasts and virtual workshops, you will see the webcasts that happen every single day. 30 plus webcasts a week. We record all but 2 of those. The 2 that we don't record focus on exchange traded funds, ETFs, and we don't record those for regulatory reasons. That's it. That's the only reason that we don't. And those are the only webcasts that we don't record. By the way, remember, this workshop, this virtual workshop, is being recorded. But we also have, in addition to those tools and resources, we've got a series of on-demand webcasts that can give you additional information about advanced option strategies, long verticals and diagonals. By the way, we're going to be talking about diagonals tomorrow night. So those are some great resources. And then those in-person events that we've talked about. New York is closed, but boy, we've got some room, a little bit of room still in August in the Chicago workshop. So if you've got some opportunity to travel with us, or you live in the Chicagoland area, come and join us on August 15th and 16th. That is at no cost to you, just like this event tonight is at no cost to you. And you can also join us if you're in the DC area. We're going to be there on the 12th and 13th of September. And then we're going to be in Dallas for a market drive event. Then we're going to be back in Chicago. We've got lots and lots of great resources for you to join. None of these cost you anything. All of these are great resources. And look, if you want to learn something about a particular topic, come right over here to the youtube.com/@Trader Talks webcasts. And you've got a number of playlists. But if you wanted to get a jump on tomorrow night and you wanted to learn a little bit more about diagonal spreads, just type in the word diagonal into that search box, hit enter. And now you've got long diagonals using leaps. You've got using stock charts to plan a diagonal spread. Advanced option strategies tomorrow night. That's our webcast coming up. Diagonal spreads, long verticals and diagonals. Back to school diagonal spreads, long verticals and diagonals. Covered call affordability problem. Poor man's covered call, which is a version of a diagonal spread. So you've got lots and lots and lots of different types of webcasts that you can go to. By the way, here's the one that I taught today, Trading Index Options, and it was titled VIX is Low, Time to Go to a Calendar Spread, where I talked about that 2 days till expiration, low volatility calendar spread. Now, you've got one other resource that I wanted to bring up, and that is this resource right here. I think I've got it pulled up. I had it pulled up. I don't remember where it went. Let's see where it went. It is the Event Hub. There it is right there. Okay. It is your personalized event hub. And this personalized event hub, I happen to just get logged out of it. So, but this is going to give you the resources. You can see the replays for the ones that we've already done. Those are right there. You can see the upcoming events. You can get the resource guide. You can see the course material for this information. That resource guide right there, the agenda, this is your personalized event hub. for this particular event. So, Ray and Scott, I tell you what, I mean, we've been kind of rocking and rolling with this in terms of these calendar spreads. And we've given them some great resources tonight. We've got that feedback survey. They can also follow us, by the way, I just wanted to mention this, on X, and they can follow you guys too. My X handle is at Ben Watson CS, but Ray is at Ray Kimbrell CS, and Scott is at Scott Durfee CS. Yeah, I know you guys post out there. I post on X all the time. You guys are posting stuff there too, right?
Yep. Time to time we get in there and do some cool things, and it's great to see everybody's comments. Great to see everybody when they come to live events as well, Ben. Like I said, we got a few of those coming up. So when you get a chance to come out and do that, and folks, I tell you, one of the best things to do is take advantage of the webcasts, and you can see all the great instructors out there, all the great coaches, and just type in what you want to look for, or just type the person's name in. Type Ben's name in there, and you'll see all the things that Ben teaches. So take full advantage of that. Yeah.
All right, guys. Well, tomorrow night, like I said, we're going to be talking about diagonal spreads. So if you liked calendar spreads, you're probably going to, I can't guarantee it, but you're probably going to like diagonal spreads too, because now we're going to split not only the expiration dates, but we're going to split the strike prices as well. And that's going to be a diagonal spread. And we're going to see what that looks like. And some of the same reasons we might put on a diagonal spread are some of the same reasons why we might put on a calendar spread. So, guys, thanks very much. Thanks to Ray and Scott for helping us out tonight and being there and answering your questions along the way. And we will see all of you again tomorrow night.
Yep. Just want to say, hey, hit that survey for us, folks, and hit that like button also. And we
like and follow.
Yep, and we'll see you tomorrow. Same bad time, same bad channel to steal Scott Durfee's comment. There you go.
You don't have to steal it. You can have it. Thanks, everybody. Have a great night.
Take care, everybody. Bye-bye.